Welcome to RenMac Off Script, where we'll discuss markets, economics, policy, history, and life. It is the 22nd of March, 2024. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account at RenMac LLC and our LinkedIn page. We're going to talk this week a little bit about inflation, about the Fed, EVs versus the UAW in the state of Michigan, something I'm near and dear to. 52-week highs in the market, breadth expansion, a little bit materials, a little bit energy, a little bit everything, as we always do. Let's talk first about that state of Michigan and the importance of EVs versus the UAW and why this is, I know it's not an arcane issue that's being too inflammatory there, but it certainly doesn't seem to be one that would be at the top of the most important thing happening, but it actually is for political reasons. Steve, why don't you walk us through a little bit why that is important and kind of what the paths are here?
Well, sure. I guess I'll start big picture for the presidential race because the politics are driving the policy here, and you need 270 electoral votes to become president. And right now, if you're Trump, you feel pretty good about your odds of winning back Georgia, candidly, because they don't have a black candidate at statewide office this time compared to Raphael Warnock, Stacey Abrams. They were both at the top of the ticket either in 22 or 20. And then in Arizona, you are sort of banking on their border concerns being a primary motivator, and polls show that's obviously a liability for Biden. That means Trump's still short, and presumably he needs to flip one of the three sort of blue wall states of Wisconsin, Pennsylvania, and Michigan. And I think he feels the odds may be best about Michigan. And I think candidly, Biden feels some vulnerability there because of his position in Israel. That's why you see the White House sort of shifting almost some would say more of a pro-Palestinian point of view. And then on the auto workers are concerned that their jobs are going to go away with part of this EV transition. Biden's saying that, they're going to increase jobs in terms of, auto manufacturing. That may be true in the short term as they try to do both gas-powered cars as well as the EVs. But what you saw with this new EPA mandate is that clearly the goal is to transition away from those internal combustion engines and go to electric vehicles. So the UAW leadership has endorsed Biden. They did that in 2016, but that was where you saw the divide between the workers and the leadership. And Trump sort of trying to play into that concern for those workers there by saying that your jobs are going to go away. And it's not just sort of this domestic concern with the EV transition. That's when you get into what's happening abroad. You saw Trump, I think the week before, talking about 100% tariffs on Chinese EVs made in Mexico. You have Tesla and others sort of looking to try to build their production facilities there because they benefit from Trump's USMCA. They have the origin rules there with respect to the auto content, so they actually qualify for a lot of the subsidies that Biden Democrats are including. So this is where you see sort of everything coming together. So the combination of Trump's comments about the Chinese tariffs, you have the EPA mandate. I mean, I yield to you. My guess is a lot of the EV makers probably weren't looking so hot this week.
Well, I mean, honestly, if we look at our risk-adjusted rolling return models, autos are actually in worse shape today. This is for the Russell 3000, so you have a lot of those, clunky EV guys in there, are in worse shape today than they were at the bottom of the great financial crisis. So your risk-adjusted returns have actually been worse in a basket of autos than you were at the depths of, these guys testifying before Congress and the like. In fact, if anything, I would make the case that GM is probably the best of the charts. Not one that we'd endorse, but if I had to pick one, GM certainly looks to be the strongest.
I actually, if I could just jump in there real quick on the EPA rule, just in terms of what had been telegraphed last spring, in terms of a timeline to get to that desired transition date, Biden did relax that a bit, probably because he wants to appeal to those auto workers. The other thing that I think when you talk about GM and some of the others there was this time they actually included hybrids as part of the calculation in terms of their desired goals there on the emissions front. And I think that's really important because a lot of people, at least some of the climate crowd, views hybrids as almost competition for EVs. But if automakers that are producing more of them, I think they're probably the ones that, as a result of this new rule, stand to gain here. And my guess is they help shape it a little bit. But I just point that out.
Great article in the Wall Street Journal. Well, more of an opinion piece than an article by Greg Ip. basically
to me.
talking about when, in the beginning of China's sort of opening up and ascension to the WTO, the expectation among the West was that China would become more like the West, when in fact, now it looks like the West is becoming more like China, sort of
That's
more of a
funny.
state capitalism driven model, picking winners and losers, clearly, running more of an industrial policy. Anyway, interesting read, food for thought.
Funny, but sad at the same time. And I would say more true than not. Powell was out this week. We had a Fed meeting, Neil. What was the takeaway? Did it change anything in your view? Clearly the markets liked it. But what was your interpretation?
Well, isn't it you that says, I don't even care what's in the statement, just show me how the markets respond and I can tell you what the Fed did.
See, you're becoming a technician more and more and more. I'm rubbing off on you.
Yeah, well, I thought the market response was the right one. I think the important thing is that despite 2 months of stronger than expected inflation data, that's not going to undo the 6 months of progress on inflation that the Fed saw before that. So we went into the year with a lot of progress. We had a couple of months where some of the progress was undone. But that's not enough to change the overall story. And so even though the data may have not gone, the right way, Powell is kind of sticking to his guns and looking at the overall trend in inflation, which is still lower. I think what's important also is that when you think about how policy is set, the Fed believes they're running a very restrictive policy. That's their language, not mine. Significantly restrictive. If you believe that, you're going to be much more sensitive to potential downside growth surprises than you are going to be upside inflation surprises. And so, I think the odds of June rose after this meeting. I think that makes sense. I also think that there's some room for May probabilities to rise because there is a potential that, you get some downside surprises on inflation between now and then. And so, that's sort of where I'm at. I do think that Powell is right to make this. If you call it making a bet, he's putting a lot of currency in the idea that there was some residual seasonality at play. But I do think that's probably the right call. And it's for me, it's where's the inflation really coming from? If you look at compensation growth has been moderating. Over the last couple quarters. And, given the dynamics in the labor market with quits basically below where they were just before the pandemic, it's really difficult to see, measures like the employment cost index perking back up. So if productivity is a little bit firmer, as we've been writing about, and compensation growth is running 3.5%, you're basically at the Fed's longer run kind of inflation objective right there.
And you actually think because it historically works with a lag, you think the whole AI productivity boom is still very much in front of us, not contemporaneous.
Yeah, it's sort of the productivity paradox, the solo paradox. The idea that you're talking a lot about breakthrough technologies. If you're talking about it, it's probably not yet in the productivity statistics. And the reason is because it takes time for people to make the knowledge investment in that technology, right? So just because there's some hot technology out there, that doesn't necessarily mean that people are up to snuff in terms of how to get the most out of it. And that process takes time. You can kind of liken it to the personal desktop computer, right? That was making its way into corporate America probably in the early 1990s. And it wasn't really until the late 90s that productivity took off. So, it's the reason why productivity is up is primarily, in my view, a function of normalization dynamics after the pandemic, right? You had people quitting their jobs all the time, and it's hard to get productivity if everyone's quitting their jobs at the same time, and you're not keeping the seat occupied. You need to actually be present in the job to be better at it, right? And then supply chains were a disaster for a while, and now they're kind of in a better place. And so, that should help productivity as well. So it's really those normalization dynamics that I think are driving the bus here. But, it's important to note that we're coming off a period of essentially negative productivity growth, if you look at the data, and now we're running at something more normal, like 1.5 to 2%. The AI stuff, if it were to kind of happen, that's going to push the trend of growth up for years, not just a kind of one-off thing. This is sort of new economy type dynamics, right? And so, and that's typically what you see when there's a fundamental change in the growth trend. And, you tend to see surprises to the consensus be positively correlated. So, they're small at first and they get bigger and bigger, but that lasts for a number of years, just like it did in the 90s.
Yeah. The most relatable paradox I can think of is damned if you do, damned if you don't. That's I seem to live my life by that one. Steve Pavlik, we've got a government funding issue. Speaking of damned if you do, damned if you don't. Government funding, you don't see this as a problem. Give us a real quick 30-second take on that.
Well, sure. I think we should timestamp this about a little after 9 on Friday morning. Congress does have a deadline by midnight tonight, technically Saturday morning, before partial government funding shutdown could take place. Keep in mind that the real probably deadline is Monday. That's when most people would be impacted here. It looks like the House does have the votes, and a lot of the people that are objecting to the 72-hour rule that Mike Johnson, the Speaker, seems to be ignoring here, probably weren't going to vote for it anyway, just because they're from the far right. So you have a situation now where the House is like the Senate, where everything sort of passes with basically unanimous Democrat support and about half Republican support. Questions in the Senate. Can they get agreement on time? I think the thing that's really probably the best motivator for them is the fact that they're looking at a 2-week recess. So everybody wants to get out of town. Everybody can sort of agree on that. So maybe Republicans won't be as aggressive in some of their amendment demands, but I don't think we're at a risk here of a government shutdown. Worst case scenario, we'll get some sort of stopgap to get through the weekend to avoid it.
You reap what you sow. It's hysterical how upset they are with Mike Johnson, even though what do you expect when you put a nobody in there, right? Maybe you should have kept McCarthy, but I digress. Not like a California Republican from Orange County couldn't help you in those swing districts, but let's go with the guy from Louisiana.
Well, in terms of the overall market this week, we did see, in fact, just yesterday, obviously Powell helped to put a little bit of fuel into equities. We've been talking about the extension or severity, the extremes that we're seeing in high momentum versus low momentum names. Still the case. We're in the 94th percentile here in terms of performance between those two factions in the market, the high momentum names versus the low momentum names. Usually you'll get a contraction in that, but it tends to happen not in a bearish representation for the market, but actually in an improvement in breadth. So we'd actually expect that the Q5 names would start to come up. And we're seeing some of that. 52-week highs expanded yesterday to the highest level that we've seen in 3 years. And the reason that that's important is because it's pretty unusual to find that the market peaks at the same time or coincidentally with the peak in internal new highs. In other words, what tends to happen is that internal highs will expand, the market will be going up, the market will continue to go up as those internal highs start to soften, and you create those divergences. And those are often months in duration between that peak in the internals and the final peak in equities. So really, if anything, that expansion in highs is affirmation of the bull market. Overbought, sure, but a big problem, most likely not the case. We are starting to see some of this pick up or percolate in energy and material names. I think it's probably the hardest call for us here because on a relative basis, if you look at the relative charts, there's really no discernible improvement. I would say maybe some of the copper names are in there, but there's no discernible improvement in the relative performance of materials or energy broadly. And yet, if you look at the absolute charts, you'd look at the charts and say, I'm a buyer. They're breaking out. They look good. I want to own those things. And we would totally agree with it on an absolute basis. The question is we're here to help to outperform. Are you really gaining anything by owning those names? Sure, having some exposure is going to be important just from the benchmark perspective, but we're really not seeing them develop yet into leadership. So that'll be important. I think it's actually a very bullish message from the takeaway of what's happening underneath the surface, which is, the economy is in good shape. The credit conditions continue to do well. Industrials, most of the cyclical stuff continues to do well. They are outperforming. Those are the productive assets in the economy. And yes, you're seeing energy, you're seeing materials do well on an absolute basis, but they're not outperforming, which is really just a testament, in our view, that the global economy is in a pretty good place, but it's not soaking up the excess capacity and forcing these supply constraints. So I think that's good news. You worry about those outperforming at the end of a cycle, and that's the point where it kind of chokes itself off in terms of the demand for those scarce resources. And we're just not seeing that. We're seeing demand, but we're not seeing it at the expense of other parts of the market. So, Neil, what do we have next week in terms of data?
Well, next week we're going to have durable goods orders for February. As I mentioned, the manufacturing data has generally been getting better. The Philly Fed showed a big uptick in capital spending intentions. So we'll see if that kind of is corroborated by some of the hard measure of economic activity. So that'll be a proxy for business investment. We also get consumer confidence. Obviously, the news on the economy has been getting better. The stock market is going up. That might be offset to some extent by what's happening with gas prices. And then we're going to get the core PCE number at the end of the week. It is going to be Good Friday, however, on the 29th. I think the markets are closed. Correct me if I'm wrong.
They are, yes.
But we will get the personal income and spending data on that day, and core PCE is expected to be out. We're looking for core PCE to rise 0.3%. Interestingly, Powell kind of talked about this at the press conference after the meeting this week, where he basically gave away the forecast for core PCE. I think he said something well under 30 basis points. It was interesting. He kind of framed it in those terms. But remember, when you get CPI and the producer price index, you're basically over 90% of the way to the core PCE number, right? Those are used as inputs into the core PCE estimates. That's it.
Beautiful. Steve, I think it's pretty quiet in the swamp, but what are you watching next week?
You're right. They've got looking at a 2-week recess here. It's hard for Congress to hurt us if they're not around. But the thing I would watch is actually Monday on the political and presidential front. I believe that's when Donald Trump has to come up with about $500 million of a bond. I'm curious to see if he doesn't, whether New York Attorney General Tish James is actually going to try to seize Trump Tower. Interesting politics with that. It might actually help Trump, some believe, because it sort of plays into his martyrdom claim. And if anybody's looking for an interesting clip to watch, you should check out on YouTube the New York Fire Department reception when they actually introduce Tish James. Needless to say, they were not that thrilled with her.
Interesting. Maybe they should just demolition it. What would that do? Just bring it down.
Well, I'm not a lawyer, but I assume that there's some other partners here that are going to have some claims on the building and stuff, which is why, usually you don't get into actually seizing real estate. Ordinarily there's some insurance and the like involved, but that's been an issue for Trump. And obviously campaign funds are going to be an issue as well by significantly outraising him. But that said, I mean, Hillary Clinton had twice as much money in 2016. A lot of good that did her. And at this point, too, I mean, if you just think about the dynamics of the race, I mean, Trump's been on the political scene now for almost a decade. I think people's opinions on him are pretty well formed one way or the other. So I don't know how many persuadable people are really out there, but it's better to have money than not.
Yeah, the martyrdom issue, I just think, is completely overlooked or not appreciated by the left on this. And just shut up. Like, just shut up. You don't need to make a name for yourself. Just shut up and let it go. Unbelievable. Well, we'll continue to watch the performance on a relative basis. This momentum trade, looking for that convergence between low momentum and high momentum names. The place to hide out in our view is actually in beta. Interestingly enough, as momentum has surged, beta actually has not been the big beneficiary here, and that should start to improve as we go. So that's one of the factors that we're watching as we pound forward. 50-day moving average on the S&P continues to be important in our view, and I'm going to get that for you right here. I should probably have that at my fingertips, but of course I do not. And it is, come on, Bloomberg, 5,000. What a nice number. So 50-day moving average at 5,000, ascending. That should hold as good tactical support as we continue on this bull phase. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and LinkedIn. And if you want deeper insight, you can join us at renmacaccess.com. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.